Welcome back to another episode of the Lender Podcast. My name is Bryce. I'll be your host today. And today I'm very excited because we have a special guest, Mr. Loren Wernette. Loren, how are you doing?
I'm doing fantastic. How are you today, Bryce?
Hey, I'm great. Thanks for being here. So before we get started, I just have to say, is this not the most like kick-ass community that you've ever been a part of? Because I feel like every like lender that I talk to, they're so like willing to chat, hop on a phone call, just jump in and like say what they're doing or what's worked for them. And I don't know about you, but like at least when I was more like in the rentals and the flipping, there was kind of like a maybe like a slimy aspect to it. Like of course there's always like the good ones out there too, right? But there's also like the gurus and the people who are just selling courses and things like that. But I haven't necessarily found that to be the case in like the lending space. So um anyway, it's I just love to like chat with people and see what's going on. And I just think the community is so kick ass. So I don't know if you found the
Yeah, I
same, but
agree. I think the reason that a lot of us got to where we are in life is by being open to other perspectives and willing to learn, right? And that's what makes it so awesome is everybody just wants to learn everything that they can, which makes great conversations.
absolutely. Yeah, it makes for a really cool group of people. So anyway, okay, so with that out of the way, let's like we you and I met not that long ago. We're in a similar coaching mastermind group, and as soon as I remember reading through like the live chat that was on the side, and you were talking about lending and real estate. I was like, I wonder if he's in that. So yeah, we connected right away, and like I said, you like within that first week, you were happy to hop on a call and just chat. So obviously, I know you a little bit better than the rest of the audience, but give us just kind of the high level overview, the elevator pitch. Just tell us about yourself.
Sure. Loren Wernette, live in North Carolina. I own and operate REI Transactional, which does short-term lending for real estate developers and flippers. Prior to starting this, I built out a 86 unit rental portfolio in about 3 years. Did a bunch of flipping as well, and then basically got to the point where I was realizing I was making as much or maybe just a little bit more than our lenders and doing a lot more work. And so started the lending business about a year and a half ago, focused on wholesalers and double closings, then added gap loans in end of last year. And so far this year, we've lent out about $2 million, just under $2 million, with another three-quarters of a million going out in the next 3 weeks. And expect to just keep growing from there. We've got a ton of demand and some of the best investors that I work with that are extremely loyal. Over the course of the last 3 years, I've borrowed from them about $10 million and paid back to them pretty considerable returns.
That's amazing. I love it. Okay, so we've got a lot to unpack here because I know you just barely quit your W-2 job a couple weeks ago, which congratulations, that's very exciting. Um, but it's interesting because I had no idea that you had a background in crop and soil science. That is
Oh, yeah.
a very um, very unique. I don't see a lot of people in that industry that move into real estate. Usually, you have like the tech bros or the engineers or the finance guys. Like they seem to do that. But I'm curious, when you got started first with like the rentals, was it out of interest? Was it out of desperation? Was it, how did you get from plant and soil science to real estate investing?
So I've gone through a couple different shifts in my career, and the reason those shifts happen is because I just have an insatiable desire to learn new things.
Mm,
So real estate came not because of an overall love of real estate, but a desire to put my family in a better position. COVID happened in 2020. We had a small baby and two small children, and I just didn't want to work in a 9 to 5 job the rest of my life and asking for time off. And so we started down a couple different paths. We had an Amazon FBA business for about a
mm,
year, then shut that down, and then started into real estate as I just saw that as the best opportunity, best vehicle at the time to pursue my desire of financial freedom. And along the route, I never really thought about myself as a real estate guy. Like I was using real estate to do what I was doing, but I was always more of a business guy, right? When I was in crops and soil science, I actually was a junior partner for a small consulting firm there, and then left that to go into sales for a large corporation, and then did that, worked for that large corporation for about 10 years where I realized I really didn't like working for large corporations. and then just recently left that. But real estate has always been a vehicle, but business is where I'm been more interested in, and
Mm,
probably why I've leaned heavily into and have taken a full shift towards the lending side of things, versus like the rentals, which I'm, in the process of exiting out of and selling my half of those to my business partner. It just fits my overall long-term goals much better than the rentals do, and allows me a lot of opportunity for growth.
I love it. I love it. Okay. And it sounds like we're in a similar spot in the sense that like you're a serial entrepreneur. Like you've got a graveyard of past businesses that either worked or didn't work. And like I think we all do. I don't want to touch on it too much because it's kind of the outside of the scope of this podcast. But I'm curious what happened with your Amazon FBA and why that didn't work and why you saw real estate as such a good vehicle moving forward to transition out of that.
I mean, so we started it, like I said, when we had a couple small kids, and we were making okay money, but the margins were relatively tight. I think we were averaging about 16 to 18%, and we were
Mm,
doing everything ourselves. And it just basically came down to there's got to be slightly more passive ways to make money without having to give up all of our time with our kids. Because at that time we were sourcing a lot of products. And then when we were done sourcing, then we were labeling and packing and shipping stuff off of
fulfillment,
Amazon.
everything.
And my
Mm,
wife and I were both involved in it. And we were giving up a lot of time with our then, like 4 or 5 month old and our 4 year or 5 year old and our 3 year old at the time. And
wow.
it didn't seem worth it, for we were giving up more than what we were getting. And
Absolutely.
so we're like, we're going to just park this. We got some retained earnings from this, and we're just going to find some other vehicle to drive us forward besides this.
I love it. Hence the rentals. Okay, I great. That's beautiful. And full disclosure, we found the exact same thing. I've had different digital product services and little one-off businesses here and there, but like we didn't really kind of catch our stride until we got into the real estate thing.
Mm-hmm.
I remember when we first got started, we bought. Like my wife and I, we were both house hacking at the time, even before we got married. And I remember when we sold our first property, we walked away with a check for like $40,000 or something like that. And that was the light bulb moment for us. It's like, whoa, there's something to this. And then you kind of like, once you get that taste of blood in the water, then you go all in and you just go ham and go full fledged into it. So that's great. I love it. I'm curious about your progression from the rentals to the flips and to the lending. Can you elaborate a little bit more on that? And I see this very very often. Like it's a very common trajectory and path. Like you see a lot of people who start with the rentals because it's the lowest kind of barrier to entry. Like, okay, I'll just get like one or two doors. Then you get the taste of the cash flow and you're like, okay, let's scale this up. Then you get tired of the rentals, you move to the flips, then you do some land development and land flipping or whatever. Then you move into the lending side. So give us kind of like the high level overview of your transition through those different phases.
Yeah, so I fell into the trap that a lot of new investors fall into, like, oh, I'm going to buy all these rental properties and I'm going to have all this passive income, right? And I'm going to buy all this stuff and I'm going to live off the rental income. It's total BS, right?
Uh-huh.
And so we got into that and realized that you can't live off that. And actually, you just basically need to sit on all your rental income for when that HVAC goes out or the roof goes out. And so my goal then became, how can I shorten my cash conversion cycle? Because with rentals, the cash conversion cycle is extremely long. And so we're like, well, let's do some flips. We had some properties that we were kind of looking at to be rentals. Like, let's just flip them and we can get cash so that we can, have some cash in the bank, and all, as well as pick up, like we had HVAC go out. We needed some additional liquidity. And so we did some flipping, and then we're like, okay, how else can we shorten the cash conversion cycle? So then we started a wholesale business because we also wanted to increase our amount of leads coming in for our rental portfolio. And then all along the way, as you start taking on more and more things, and a lot of people talk about this, right? You have so many things going that you're not giving enough time to any one thing,
Mm,
and then everything starts suffering. And
yep.
so while we have the wholesaling and the flipping and the rentals, like some of the flips didn't produce as much cash as we wanted them to. And what I saw was where we maybe made $15,000 on a flip because, the market shifted on us a little bit. We still made money, but our lender, who was funding it, he made like $18,000 And he didn't do anything. He wasn't chasing contractors around. He wasn't trying to pick out LVP. He wasn't doing all these things. I'm like, all right, so that is very appealing to me. And that how do I do that, right? And so some legislation came about in North Carolina last year around wholesaling for double close funding. And so basically they were saying that assignment of contracts were considered a commission, and that you couldn't get a commission unless you were a realtor. And so I saw an opportunity. Let's pool a little bit of money from some investors and do some double close funding. It'll be quick, same day, send 10,000 or send 100,000 in, get 100,001 back. Right. And so we started doing that. And a magical thing happens when you start telling people you have money. They start bringing you all these random opportunities. Right.
Yep.
And so it happens. And so most of them are total dog crap. But every now and then there's a diamond. And one of the guys I knew pretty well, he's like, hey, I've got a guy. He had some legal issues come up, but he's got some land sitting there that's got a bunch of equity on it. He needs about 200K to basically get through this other project. And he is willing to pay you a pretty significant rate for this for just like 4 weeks, right? It was going to be a total of about $10,000 profit for us. And so sure, let's do that. It was a no-brainer. Well, that project took him way longer than what it should have. And what was going to be a pretty good deal turned into like a home run, as we got all those funds back and ended up netting about a 70K profit over a 8-month loan.
Wow.
Yeah. And so while that one was going, we're like, we see a need here because we have multiple people in my network that are developers or flippers. And these guys are people that have equity in performing assets, right? They've got rental properties, or maybe they have land that's in first position, but they've got 3 or 4 projects going all at one time. And they get cash strapped because all their cash gets tied up in one project. A draw gets delayed because of permits, or contractors take too long, or something happens. And all of a sudden you got 2 or 3 other projects that are sitting there not able to have any work done to them because you have a liquidity issue. And so instead of making them go and do a refinance on performing assets they have and destroying their cash flow there for a long period of time, or having them sit there and just eat those finance charges, we'll come in and do blanket loans on their performing assets. So let's say we'll pick up 2 or 3 rental properties, put a first or a second position on them, and then provide them the liquidity for a short period of time to keep those projects moving. And then what's nice about our product is then when they're done with that, they can choose to have us satisfy that collateral that we've pulled together, or we can just sit on it at no cost. And then next time they need the liquidity, it's a quick 2 to 3 day turnaround time because we already have the collateral established. And so it's become very, very helpful for a lot of these large established flippers to have these performing assets, or even several developers that just need this ability to pull cash out quickly, get projects moving again, and then get back in the game.
Interesting. That's very interesting. So you essentially leave the liens in place, and they can use you as a line of credit, when they want.
It's technically not a full line of credit because they're new loans every time. We have origination points and stuff.
Oh, okay.
But
okay.
I haven't found a perfect name for what it is, but it's essentially a collateral that we're just holding there for as long as they want us to, right? We re-up it every year, or we'll pull it. There's certain legislations in place. We can't just leave a second in place indefinitely.
Totally. Yeah.
But like we've got one flipper that's used it like 5 times. He pulls 40, 50K, uses it for 2 months, sends it back, pulls 40, 50K. And then the other place we're finding good use of it is, a lot of people that have new construction loans going, maybe they don't want to use up all their cash in hand to fund all the framing materials or whatever. So they'll, use the collateral that they have, get 75K, buy all their materials, and then use their draw to pay us back. So
amazing. Okay, so there's 2 main things that I want to unpack here. There's a lot of good points, a lot of ways we could take this, but the first is when you talked about how you made 15 grand and then your lender made 18 grand, and we had a very similar experience. We were flipping a property. It was right around COVID. Just about everything that could have gone wrong did go wrong. Like some projects are just like that. And I remember, so it was, we were having problems sourcing different materials. So like we had this house that was almost completely done. The only thing that we couldn't get was baseboard. And I remember at the time, I was calling every warehouse, every supplier, every distribution company that I could think of. And I'm like, look, I'll drive 12 hours to you with a trailer to get, to like get baseboard so we can finish this project. It was a nightmare. And in the end, after everything was all said and done, we sold the project. I think we basically broke even, but I think we made like $1,200. And I
Mm-hmm.
remember looking at the HUD statement, and our lender had made $25,000. And I was like, oh, you got to be kidding me. Like, this dude, like, he didn't lose an ounce of sleep. Like you said, he's not picking out flooring and driving across the country to source materials. It was just a nightmare. So that was for us when, again, that light bulb moment went on. We're like, okay, we gotta transition more into this. So I resonate with that very
Yeah.
closely. And then
And
um,
we always tracked how much we burnt per day in interest charges. And so it's interesting to be on this side versus that side, because that side, every time a closing was delayed by a day or two, it's like, oh, that's $75 in the backwards. That's $75. On this side, it's like, oh, there's 75 more. There's
yep,
75
yep.
more.
It's just the inverse, yeah.
Yeah.
Which is funny because that leads into the next thing I was thinking about. That really quick 4 week like bridge loan, or supposedly 4 week bridge loan. I can't tell you how many borrowers we've had who have said it'll be a really quick project. It'll be a super quick project. Like, and it's funny because in the beginning I was so naive to that. I was like, like I was thinking about this particular individual. And we actually did another episode on the podcast talking all about it if you're interested. But we this individual came to us and said, "Look, I'm kind of strapped on cash. I don't have a lot of funds. This will be a super quick project. Would you do 2 points instead of 3 points?" And it was like supposed to be a 2 week deal. I was really tempted to like do just the 2 points, help the guy out. But in the end, I was like, no, sorry. Like the points are that's how we fund our business. That's how we run. That's how we operate. And so we didn't negotiate on points. We still have that loan on the books, and it's been going on for about 7 months, and it was supposed to be a 3 week project. So it's very interesting to me that you've had the same experience. And I think a lot of lenders probably have, but um, projects don't always go according to plan. And that's what's so great about being on this side of the business. This business model is when things don't go according to plan, you make more money. And that's not to say that you don't want your projects to go according to plan, right? Like you want to have a good relationship with your borrowers and make sure that they're successful, so you can also be successful. But just intrinsically, it's a better business model because you make money the whole time, regardless of how the project goes. So anyway, interesting.
Yeah, I 100% agree with that. I think that you and I both have a unique perspective that a lot of people in the lending space don't, that are doing similar, that we've been in those trenches, right? We know how projects can go sideways. And so like someone comes to me and said, oh, this project, we're finishing up paint. We're going to be on the market in 3 weeks. And I just kind of chuckle at them. Okay,
Yep.
okay,
Good
so
luck.
you're going to be on the market in 6 to 8 weeks, and then it's going to take 4 weeks to find a buyer and 4 to 6 weeks to sell it.
Exactly.
So like we instinctively have a different level of knowledge that not only helps us talk to our borrowers like, do you really want to make this decision to borrow this money, because we want to get paid back, we want you to be successful, but we really want our money back. And we're also have the ability to look at a piece of property and be like, okay, the appraisal came back at 237. There's no way if I have to sell this today in its current state, I'm selling it for 237. Like it's, December, if I'm going to try to turn it quick, like I'm going to put it on the market for 199. And that's the price I'm going to use to run my comps on, because at the end of the day, I've got to make sure my money, and more importantly, my investors' money, is fully protected. And so
Absolutely.
using just whatever an appraiser says that has absolutely no skin in the game is never a good idea. You got to look at all the pieces of data you have, and then you have to use experience to understand what this market is going to do and what you actually could get if you put the property on the market, and use that to figure out what your LTV is and what you can loan at.
I love it. I love it. There's a lot of times that borrowers will come to us and they'll obviously they're going to give us optimistic numbers. They want the highest LTV they can get and things like that. But when I was flipping houses, there were a number of times, and we had probably 2 or 3 lenders that we used like pretty regularly. I think I had a situation with each individual lender where they said, Bryce, do not do this project. They said, I mean, I would not do this project. You're welcome to do this project, but I won't be the person funding it. And that saved me. Like we had a lot of really good deals that did go well. We made a lot of money and we did just fine. But having that second set of eyes was so invaluable to us because it was just another, guess and check, right? Like it was another checks and balances to make sure that everything was good. And so as a lender, you see a lot of deals come across your desk. You look at a lot of projects, you look at a lot of numbers. And because of that repetition and tie that with the background that you had as a flipper already, like, your market, your numbers, like you said, like, okay, you're not going to list this on day one and have it sell the next day. Like it's going to take 4 weeks to find a borrower. And then it's going to take 30 to 45 days, assuming no issues, to close. Like it's having that experience and having that background is so huge. And I see a lot of people who are like, oh, I want to get into the lending space. If you don't have a background in real estate, that's probably not a great way to start. Or maybe you disagree with that, but I would assume you're on the same page.
I think anybody can do anything if they work really hard and,
That's fair.
learn it, right? I think that the learning curve to get into real estate lending without having a real estate background is extraordinarily steep because there's a lot of nuances that come into play that you just aren't aware of when lending or when borrowing, even if you haven't been there and done that and seen a bunch of closings.
Absolutely. I remember there was a borrower that came to us. She was looking to flip her first house, and since then we've kind of changed our model. We don't give funds to first time flippers. We want to see like at least 3 to 5 HUD statements. But again, that was kind of in the beginning when we were a little bit more ignorant. But by at this time we had still flipped about 80 homes. So I remember going out, meeting this girl, walking the project, and I remember thinking, man, this girl is so clueless. Because I remember we were walking around the property. She was just like casually saying, oh, the roof is fine. I'm like, in my head, no, the roof is not fine. Like you can see all the missing shingles. Like this is going to have to be replaced. That's at least a $12,000 expense. And then she said, okay, there's this like lean-to covered carport. And she's like, I'm going to extend this out and I'm going to make it into a 2-car garage. I'm like, what? Why on earth would you ever do that? And then also I said, no, you can't, because if you do a 2-car garage, that door is going to be at least 16 feet. So your building's going to be at least 20 feet and you're going to run into your setbacks on the side of the property and the city's not going to allow you to do it. It's just like all these things that for you and I, that just is common sense. Like, no, you don't do that. But if you don't know what you don't know, then, how are you supposed to do it? So, anyway, I could hit on that all day, but it would be very difficult to get into this business unless you have that experience and unless you've done it yourself a couple of times.
Yeah, it's so true that there's just like all these tells that you can tell that they're not experienced, right? But picking out the ones that are experienced based on who's being conservative in their numbers, who's bringing you good deals, who's not wasting your time is the key to being successful at this side of things. It's also the key to being successful on the other side of things. And you really want, like, my goal is to find a good set of key borrowers that are going to use my services over and over again, and they're being successful, and then my investors are being successful, and I'm in the middle being successful, helping that along the way. I think you made an interesting comment, like, oh, we don't invest to new investors, right? And I think that's a general consensus across fixed and flippers, but it leaves everybody in kind of this interesting spot where I can't get experience because I don't have experience, right?
Right.
And I thought about this a little bit in the past, and it's not my business model, but I feel like there's something out there where there could be some sort of mentorship program that a fix and flip company or lender puts together, where you've got, borrowers that have experience and you've got new borrowers that don't have experience but have deals. You could pair them up with your money and create some sort of program to nurture and create lifelong or long-term customers that now have the experience, that have been trained up in the ways that you like to work in.
Yeah, we've done stuff in the past. Like if you mentioned something that, like, when you're talking to somebody on the phone, you can just tell, the way that, like, the terms and the vernacular that you use, you can tell if they're experienced or not. And what we've done in the past is if we can tell someone is less experienced, but you can also tell that, like, they're a go-getter, that they'll be able to, like, at least kind of handle the project. If they're newer, what we've done in the past is we've just, like, JV'd with them on the deal. Like, we'll be the money partner. You do the project, but I'm going to hold your hand, but obviously that takes, more time out of your calendar. And so we're going to split the profits 50-50, or maybe 60-40, or even 70-30, just because I'm going to be doing a lot of the heavy lifting and I have way more to lose than you do. But if it's a home run deal, it's kind of hard to pass those up. So we've done that in the past, but we mentioned being a little bit more passive, like talking about your FBA business. Like, you were doing all the fulfillment, you were doing all the inventory management. It wasn't passive. And so you moved into this business. Like, there's still obviously an aspect of work to it, but it is passive, in the sense that, like, as long as everything's going smoothly, you've got a good borrower, you've got some work on the front end and some work on the back end. But during, like, the middle of the project, you kind of just sit back and collect interest, which is, why I think it's such a great business model.
Yeah, I mean, it's kind of like pushing a cart up a hill, right? It takes a bit of effort to push it up the hill, but once you get it there, then it's just going to coast down.
On
And
its way
that's a
down.
lot
Yep.
what like that, that's a lot like what a loan is. You're pushing, you're doing all the original. Well, first you got to find the borrowers, you got to find the money, then you're doing all the underwriting work. Which, I mean, if you're any good, you're doing pretty extensive underwriting. And
Yep.
then once the loan's out there, then it's relatively easy. Just kind of give it a little kick every now and then, making sure people are paying. And it, and if you're not learning all along the way, then you're really missing out. I mean, we are constantly adjusting and changing how we're doing things based on new knowledge that we have,
Right.
and when we first started, we were only doing, we were letting all of our loans accrue until the end. Now we're taking monthly interest payments. They were had to manually pay. Now we require auto ACH,
Yep. Yep.
authorization forms. It's just like, how can we continue to improve and build the process to make it more scalable, more user friendly, and less risky?
Yeah. And that right there tells me that you're a good operator. Like, the fact that you're constantly, like, iterating and innovating and changing and tweaking and adjusting, like, that's how business should be run, in my opinion. We had, it's funny, I swear, every time when we were back in our rental days, every time we had, like, a weird, crazy, like, one-off situation, our contract would get a little bit longer, and then a little bit longer and a little bit longer, because we'd add different clauses. Like, whoa, I never even thought about this situation, and, like, the fact that you are changing and adjusting, um, that's great. So, you mentioned a couple of things. I want to kind of pivot now and talk about your specific business. Dive into, like, your lending model, how you run things, structure things, because I think that probably caters or applies to this audience the most. But you mentioned something that previously in the past you would let all your interest accrue until the very end. Now you collect monthly payments. The reason I want to touch on this is because we actually don't collect monthly payments, and we really like that model. We accrue all the interest at the very end. And so I'm curious to hear your pros and cons between each model.
So the biggest pro is for the borrower to not collect, right?
Right.
Because then they don't have to worry about it. But I would say that probably some of the biggest negative is for the borrower as well, in that it's building up and they're not thinking about it, and then they go to sell it and they've got this huge bill that they never thought of. We made the shift to monthly payments primarily for two main reasons. One, if you are basing your LTV off of the as is value and you're letting your interest accrue, you are degrading your protective equity in the property that you
Mm,
have securing your investment. That is the number one reason why we are doing it. So you and I talked about how a loan is told to us it's going to be, oh, it's going to be a quick one, 3-4 weeks, and then it stretches to 7-8 months. Like, the amount of equity that was protecting our asset at the beginning versus the end, if you accrue it, is significantly less. And we want to maintain the largest amount of protective equity we can. Number
absolutely.
two reason is, honestly, if we require them to pay every month and they stop paying on month 3, it gives us a huge red flag that something's not right. We can reach out and proactively talk to them, figure out what's going on, and put a plan in place before we ever get close to that default window, or start the default process before we've accrued months and months and months of interest that we now owe to our investors, or technically owe to the fund, right? So we can get ahead of it and limit some of our impacts to that, basically that runaway train that could happen. Because if you let things accrue for 8 months and all of a sudden then they default, now you're out not only your principal, but almost 8, 9 months worth of interest. However, when they stop paying, that could have been, brought back into the fund and then leveraged towards another project and been making you money. So
Absolutely.
it is a risk reduction strategy for us, for our fund, for our investors, and for the borrowers.
Hmm. I, I love it. This, what's so great about this business and this industry is that it's so unique in the sense that like everybody does their business just a little bit differently. And um, I see the pros and cons to both sides, and just, it's just different. I'm not saying like one's better than the other. Like we obviously we have our reasons for doing it the opposite way, but
Mm-hmm.
just to, like, we have found, so I'm trying to think about when I was flipping, and we, like, say we had 10 projects going on simultaneously. um, the reason that people come to you in the first place is because they're low on capital or liquidity, right? So if you've got 4, 5, 6, 7 projects going at the same time, you could be paying $40,000 a month in monthly payments, depending on the loan amounts and things like that. So when I was flipping personally, I really enjoyed not having to make monthly payments, and we found a lot of our borrowers who have like that too. Just because it's easier on the cash flow side. So again, I'm not saying you're right is right or wrong, but it's interesting to see like all the different ways that people
But
structure it.
but there's other ways around that too, because if the property has enough equity in it, right, then increase your loan size and escrow the term of the loan's monthly payments. Then they
Absolutely.
don't have to make any monthly payments, and you're still protecting your equity.
Yep. Absolutely. Yeah. There's a million ways around it. I love it. It's great. That's amazing. Wow. Okay. Let's talk a little bit about your, you mentioned a fund, so I assume you have like a fund structure. You're not doing like the direct placement or like trust
Mm-mm.
deed investing. Talk about like your decision to go that way, what that process was, just high level overview for everyone.
Yeah, so we started a 506c fund, so I'm allowed to talk about it, right?
Okay.
But so in fund structure, and probably most of your audience knows this, right? We were looking at basically a 506b or a 506c. 506b is close family, people in your direct circle, but you're not allowed to advertise, and you have to know them directly. And then 506c is they have to be accredited, and you have to basically get proof of accreditation, but you're allowed to freely advertise. We chose the 506c side of things because we wanted to basically be able to do things like this. So advertise on Google, wherever, and so that's where a lot of our capital is coming from, is just doing Google ads, Facebook ads, reaching out to people and not having to build a network that's one person removed from yourself. We started that, and basically the reason we started a fund was the way these loans are. Our loans are maximum 6 months. And so prior to getting the fund started, we were doing kind of a direct placement model, almost like a syndication, where we would get a loan and then I would reach out to my network. We would raise the capital for it. We'd put the documents all together and then fund the loan. But when you're doing 4 to 5 of those loans a month, and those mature every 2 to 6 months, it becomes a lot of transactions required by our investors. And additionally, if I have my money, I'm an investor, and I have my money in one deal, all of my hopes and dreams are on that one deal, right? With a fund, your money goes into the larger pot, and from the day your money hits our fund, you are now fully diversified across all of the portfolio that we have. And so it's less risky, and we're allowed to give percent or profit sharing. So our fund is a 15% pref with a 60% profit share, and so we're able to give much better returns because our investors are trusting us with money for a longer period of time. It's allowing them to not have to do transactions, all the time, and do their own due diligence on each one of those deals. But it does require them to know us, trust that we're making the right decisions, and believe in our underwriting process, that we have their best interest at heart. So there is a bit of a push-pull. And I've had investors that have invested with me for years that aren't big fans of the the fund structure, because they want to be able to underwrite every single loan that comes in. And as we look at our fund model as a way to scale our business, beyond where it is today and beyond where I think it will be next year, the ability or the desire to share individual documents on every single deal with every single investor that we work with, isn't very appetizing to me. Not because we have anything to hide, it's just a speed of moving forward, right? We
Absolutely.
want to have excellent customer service for our borrowers, which means collecting all the information that we possibly can get from them to make sure the loan is as riskless or secure as absolutely possible, and then be able to fund that as soon as the title work is done and we're ready to move forward, and not have to wait for someone's self-directed IRA custodian to send the funds over, or whatever the holdup might be. We want to make sure things are moving. And we also want to make sure that we have clear visibility into exactly what our dollars are doing, where they're doing it, so we can communicate back to our investors on a regular basis what's going on. And so they have peace of mind on what we're doing is the right thing and that their money is growing the way they expect it to.
I love it. I love it. Man, that's huge. So we also have a fund, and we really like that model because previously we were doing the trust deed method as well. I think that's how most people start out, or I haven't heard of a single person who hasn't started out doing that method. And we, for so many reasons that you just mentioned too, we didn't love that model. There's some pros and cons. Like you get to interface with your investors more, so like probably investor relations are a little bit easier. But on the flip side, we had a lot of headache with like investors not sending their wires fast enough. So we had this loan that they had committed to, and like we were at the closing table and like the funds weren't there, and so like there were some projects that we said we could fund fully, and at the end of the day we couldn't. Like at the very last minute it didn't come through and it fell apart, and for the borrower that's a nightmare because they're pissed at you, and it's just this whole mess, and it's not great. And unfortunately, even though it's not your fault, it's still your business and your company's reputation on the line. And do you think those people are going to come to you and borrow from you ever again? Like, of course not. They had a
Yeah.
horrible experience. So obviously, like that can be combated by setting up investor expectations, collecting the wire maybe a week before you need it. There's all ways to go about that. But similar to you, I like looking at the bank account and saying, yes, we can, or no, we cannot fund this loan. It just blanket. I now tell borrowers, if I say that I can, I can. If I say that I can't, I cannot. And it's just cut and dry. It's black and white. I can or I can't. And that's it. And it's worked out really, really well for us. Another thing that I did want to briefly touch on, and you may disagree with me, but when we were setting up our fund, we spoke to probably 4, 5, 6 different attorneys. I wanted to kind of get like a gambit of expertise and just different opinions on it. And what I learned was the trust deed model is actually illegal in some ways, in the sense that when you're taking a note and you're essentially carving it up and you're putting 4, 5, 6 different investors on this note, that actually falls under securities laws because what you're offering is now a security. And I don't say that to scare people, but just I know there are a lot of people out there who are a little bit afraid of the fund, in the sense that like there is some managerial overhead. Sometimes it can be expensive. There is some other stuff you need to be aware of, but also be aware that the trust deed model can be considered illegal. Again, do I think something's going to happen? Do I think you're going to get caught? Do I think you're going to get sued? I don't, because I know a lot of people who do it that way. But just something to throw out there and mention. So,
Yeah, I've heard similar things
have
about
you?
that. I
Okay,
mean, yeah, and so it's we've done them, obviously. Once
same,
in a
and
while
I
we'll
have too.
we'll
Yeah,
we'll still do them, right? And, the fund gets fully allocated or whatever, and we've got a good loan coming in. But we're actively trying to move away from them, just because we want. I mean, everything about business is what is the next issue that's going to be coming up, and how do I mitigate that before it actually causes financial stress to the business, right?
yep,
And
yep,
so, as that is a potential risk in the future, we're actively trying to navigate direction away from things that could possibly cause an issue, because there'll be enough other things that we don't have any sight on that all of a sudden pop up. If we can even eliminate a few of the things we know might be issues in the future, it puts you in an overall a lot better position.
absolutely, absolutely. Okay, can you go over like your what your experience was with like setting up a fund, rough numbers, how you know how long it took, like what was your overall experience with it?
Yeah, so overall experience was all right. I have a small fund manager mastermind that I run once a month. So there's like 3 or 4 of us. We're all in the same kind of place in the fund, and a lot of them already had funds. And so I spent a lot of time talking to them, and they already had an attorney that they'd used before. And so I already had a pretty good idea of what structure I wanted. I spent a ton of time modeling out. I have a CFO that's incredible with models and stuff. So him and I had spent a ton of time modeling out what the fund should look like. And then we went back and forth. It probably took me about 2 months, 2.5 months of
Okay.
back and forth, mostly forth to the attorney and then him working on stuff and then me redlining things to get it to the place where I was happy with it. And that includes the subscription agreement, the OA, the PPM. The PPM took I wouldn't say the PPM took the longest. We got the subscription agreement and the OA done first, and then using those, Chat GPT and another PPM that someone else had provided to me, I put another PPM together and gave it to him to review,
Nice.
and then he worked on it. So that saved me a ton of time and a ton of money, because he has had to update it as opposed to starting from a blank sheet of paper. So all in, we were probably 2.5 months from the time we started, maybe 3, from the time we started to when we actually signed documents. And then all told, I think it was just under 20 grand, like 15 to 18 grand, for all those documents.
Wow.
And we had to do one edit to our OA since then. But other than that, things have been fairly static.
Wow. Okay. And in the realm as far as like the legal space goes, that's actually fairly inexpensive. You know, I've heard of a lot of people that to get their PPM docs and everything like that, like I've seen 35, $40,000, some as high as like 60 even, you know. So like I'd say that's you did a good job. That's great.
So attorneys are very, very expensive teachers. And so if you can find even 60 or 70% of the information and put something for them to react to and create edits and redline up, it saves just tons and tons because they're all billable by hours, right?
Mhm.
And so if you can get something that you can work off of and then give it to them to update and basically know exactly what you want, like these are the things that I want in it, this is the structure I want, this is the waterfall I want, this is how I want to distribute things out, these are clauses I want in to protect myself, these are clauses I want in to protect my investor, and just spend a ton of time researching all that. The time you spend researching it and putting together an initial document, even though it's not going to be a great legal document because you're not a lawyer, but to give to them to then work on, is going to save you a ton of money.
That's a great tip because so many people are like, I don't know anything about this. I don't want to understand anything about this. Like that's your job. I'm going to pay you to do that. Um, but if you're running a fund, you probably should have some basic understanding of what you're doing. Like obviously, right? You know, like you should know the difference between a 506B and a 506C. You should know like what a sophisticated investor is versus accredited, like what it means to market and advertise and solicit funds and everything associated with
If
that.
you're running an American or European waterfall style port, I mean, if you have a fund and you're a fund manager, you should be able to quote good portion of every portion of those documents. I've read
Absolutely.
every one of my documents a dozen times. I
Yep.
was actively involved, up to my elbows in every sentence that was created in those things. And to just abdicate it and give it to an attorney and say, create me this document and then
Double check
expect
this.
it to be what you want is asinine.
Yeah, absolutely. Oh, that's huge. I love that. And so many people are like, "Well, you know, I want to hire the professional." Absolutely you do. Like hire the professional, but um time is money, but you can save yourself a lot of money. I'm a big proponent of hiring things out and hiring the right person so you don't have to deal with it, but like you know, there's a threshold for that, right? Like if you can save yourself $20,000, is it worth in my mind to sit there for a day or two and learn the terms and the vernacular and common structures? Like, yeah, absolutely. Like 20 grand is 20 grand. That's not chump change by any stretch of the imagination.
would you ask your flooring guy or would you say you have your general contractor go renovate my house and then just walk away for 6 months, right? Not tell them what kind of floors you want or where do you want the rooms or like you
Right. How do
can't
you
do
think
that. You
that
have
project will turn out? Yeah.
Yeah, exactly. It's not going to turn out good. It's going to be way more expensive because they're not going to be cautious of the budget. They're not going to know what you want. You're going to have to make a bunch of
Change
changes.
orders.
And
Yep.
every time you have to do a change order, it's the same thing as a red line in an OA or a PPM, right? It's a change order. They're going to spend more billable hours fixing that and adjusting it. And so you have to be an active participant. And, we made a ton of loans earlier in the year, and then we were putting the fund together, in like the spring, and we made very few loans in April and May, March, April, May, because I was dedicated almost all of my time to just getting those documents ready to go, because
Yeah.
that was the way of the future. And if it meant a short-term delay in putting loans out and getting revenue for the long-term benefit of having it set up correctly, because we have an open-ended fund, it's not going to go away in 5 years. It had to be done right the first time.
Yep. Yep. Go and go slow to move fast later, right? Like that's
100%.
huge. Could
100%.
you briefly, for those who are listening who aren't familiar with the required documents, the PPM, the OA, the subscription agreements, the investor questionnaire, all those things, can you just give like a high level overview of what each document does and why you need each in each individual piece of paper?
Sure. So high level, a fund is basically two entities. There is a general partnership and a limited partnership. The general partnership is the group of people that are actively managing the money. They're Bryce, they're the me, they're finding the money, they're finding the borrowers, they're doing all of that. And then there's the limited partnership. Limited partnership operating agreement or LLP, LLC, sorry, is going to be what the investors actually invest in. So when you invest in a fund, you actually become a part of that LLC. And so as the limited partnership, your role is specifically there to provide capital and get returns, while the general partnership is there to manage that capital for the LP and make sure that those performas and those returns are met and that no laws are broken, that everybody is taken care of. And so when you are becoming a member of a fund as an LP or a limited partnership, there's going to be a few documents you have to sign. If for me, like me, I have a 506C, which means you're required to be accredited. So I require a set of documents that someone else might not if they're a 506B. I require some document that states that you are accredited. So the SEC doesn't come breathing down my neck and say, hey, are all you guys accredited? And so either a letter from your accountant or proof for the last 2 years of tax returns, that you've made a certain amount of money, or basically a list of all of your assets and liabilities, excluding your primary residence. So that's number one. Number two is going to be the operating agreement for the LLC, that is the LP, and you're basically just going to sign that, and then there'll be a table at the bottom that says who you are, what your address is, how much you've committed, how much you've contributed, and the dates. And then the last document that we require is a subscription agreement, and this basically just says that you're going to be supplying X amount of dollars. This is your name, this is your contact information. It gives some high level overview of what those dollars can be used for. The third document, which you don't have to sign but is critical for a fund, is the PPM, or the private placement memorandum. And the shortest way to say what a PPM is a PPM is every way the fund could possibly lose money, distilled down into a very succinct 80-some page document. And it also very clearly says how you as an investor are going to get paid, how you can contribute money, all the rules. It is the Bible for the fund. If you want to do anything for the fund, let's say I have my fund, it's dedicated for short-term real estate investing, and I want to go and invest it in oil and natural gas. I am not allowed to do that because our operating agreement, our PPM, specifically states that we are used as a debt fund for real estate. And so it limits what we as a general partnership can do with your money, but also calls out how we are to pay you back. And if there's any disputes or anything ever happens, key man, like if I get sick or die, what happens to the fund? Who takes over? Does it get shut down? How does it get distributed? everything and anything. The whole point of that document is to try to line out every single thing that possibly could go wrong and either disclaim it or explain how it's going to be handled.
I love it. Yeah, it's we joke with our investors. When we're onboarding someone, I'll give them the PPM and I'll say, if you're having a hard time falling asleep tonight, like this is a snooze fest. This is a good way to fall asleep. But it is like you are transparent in anything and everything, all the risks. Like ours explicitly states like this is an investment. There is an element of risk involved. You could lose money. Like you want to be very transparent. Do we think that's going to happen? No. Do we have a history of that happening? No, of course not. But like there is some risk. So
you got to
yeah.
disclose it. You got to disclose everything, right?
Yep.
Just like when you sell a house, you got to disclose everything. And I don't want investors to come in and be blind, right? I want them to know what's going on and then trust that what we're doing is the right thing, because we have shown really good returns. I have a history of returning 31% per annum to my investors over the last 4 years,
Amazing.
right? And so, but I want them to know what the risks are going in. And this is also why the SEC requires people to be accredited investors for these funds, because these aren't small chunks of money. Our minimum investment size is $75,000.
Mm-hmm.
And the SEC is trying to protect people that's their last $75,000. And if they lose that, then they lose their house, right? And so they are protecting people by giving more hurdles for accredited investors to get over. But once you've gotten over it and you have those documents, it's not such a big deal. But the first time, it can be a little bit tedious to either find all those asset documents, especially if you don't have a very high income shown on a W-2, or you just have your CPA fill out a form that I usually provide like a template to my investors that get filled out. And then I have a document that says, hey, they said they're invested. The CPA said they're invested. Like,
that should be enough proof.
I don't know what else. Yeah, that's enough for me to mitigate my risk.
Absolutely.
So, and honestly, the risk of every other investor, because if we bring one investor in that's not accredited, it puts a risk on everybody. And so we have to be very diligent about that.
Absolutely. I love it. That's really good advice. Okay. All right, we're getting close on time, so I want to kind of wind down and just briefly pick your brain just on like your basic lending structure, like basic numbers, like what your rates that you charge, your points, your LTVs that borrowers expect. Just kind of give us like a brief overview of your lending model, just because like I already touched on, there's so many different ways to do this. Some people that we've talked to just have like a flat 22% interest that they do. They don't charge any points, so give us an overview of how you run and operate your business.
Yeah. So for our gap loans, which specifically what I'll talk about here, it's our flagship product. We're charging anywhere between 2 and 4 points on origination side of things. We don't loan anything less than 40,000. And our loans are all 6 months or less. Now we do allow for up to 3 extensions, with a extension costing 1 point and going for 3 months. But the loans are primarily designed to be short-term loans. And you'll see why when I talk about rates in a second, because our money isn't cheap. We specifically have designed it to be expensive because some of our loans are second position, which are inherently more risky. Now we take a lot of that risk out by the significant amount of underwriting we do and the LTVs we loan at. But we also have some first position as well. So our rates range anywhere between 2 and 3 points per month. So you can do the math. It's 24 to 36% interest.
Wow.
And we require monthly interest only payments on that with the ACH authorization form signed at closing and we also require them to provide bank statements showing that there's money in those accounts. Now, we don't loan less than 40K because a lot of times we'll have people, I want to borrow 20K for, 2 months or a month. That isn't a big enough return to make
offset
it worth
the risk.
our time.
Yeah.
And, yeah, exactly. And, the range and rate from 2 to 3 points really depends on the amount of equity that's protecting, but primarily if it's a first or second position lien collateral. So, a chunk of ground that is at 40 or 50% LTV, it's in second position, is going to warrant a higher interest rate than a chunk of ground or even a house that's at first position at 60% LTV, because there's more risk associated with a second position. So we're constantly weighing all of that out to make sure that we're producing the best income for our business while also providing a service. And honestly, we have such demand for our product that we we once in a while talk about bringing our higher rate down a little bit, but we can't keep funds in the fund. We have so much demand for it that there just hasn't been a need to bring the rates down.
Yeah.
Because you think about, like, I've got a loan going out next week. I borrow $103,000. They're going to use it for about a month, right? And so about a month. We're charging 3 points and 3 points, so 6 points. So if they use it for a month, that's $6,000, which isn't bad to get about 100K in liquidity, within 2 weeks.
That's
Right.
amazing.
And they're backing it with, a chunk of ground that's worth 1.4 million that's got a $175,000 loan on it. So our LTV is very strong there.
That's a killer deal. Yeah.
It's a killer deal. And we don't lend over 65% LTV, and that's first plus second position.
Oh, wow.
Historically, the last 150 years, the biggest downturns in the economy have caused a 30% reduction in home prices at the worst. And so at 60%, that gives us a 30% plus another 10% buffer to ensure that we can get not only our capital back, but any remaining interest that may be owed.
Very insulated. That's amazing. Wow. Do you have any issues with like usury laws or anything like that in North Carolina because you are charging such high interest rates?
So not in North Carolina. We specifically target some states that don't. So North Carolina, South Carolina, those are our primary two states right now. We also get into Georgia a little bit. Those have no usury laws on commercial loans. So usury laws tend to apply to residential loans. Now, Florida has a usury law of 18% on an annual basis for commercial loans as well. And so for that reason, we haven't extended any loan products into Florida. Texas doesn't have an issue, but Texas has got so much oil money that we haven't been able to find a good niche there because a lot of people can just find people who will give them money for cheaper. So we don't fit there. But honestly, I mean, I got $6.3 million worth of loan requests in the last 45 days. Just in North Carolina and South Carolina. So until we expand further and really scale up our business, we haven't had a need to really mess with our rates.
That's amazing. And that's great loan volume. How do you pick and choose which loans you do fund or don't? Is it just based off like collateral and equity, or like how do you pick and choose?
So it's like a trifecta, right? How much equity is in the property, what the history or quality of the borrower is, right? And where the property is. So, if somebody brings me something in Maryland and they have the other two legs of the stool, great. We're still not going to loan there because I don't know that market that well.
Yeah.
Currently. So it's got to be somebody that has a ton of equity. I know the area, and the borrower either has really good references, has a ton of capacity in their bank account, which we see that too. We see people that have, $250,000, $1 million in the bank account and still want to borrow money from us, because they just don't want to give up their liquidity in their bank account, and or the property has just a ton of equity there. There's another one that I'm looking at next, probably going to fund next week. I think that one's going to be an 18% LTV loan. So. Wow. And we're going to fund, and that's with us bringing $500,000 loan forward.
Holy wow. That's crazy. Holy cow. My goodness.
So the good deals are out there. You just have to be really selective. And, right now we're funding about 2 to 3 deals a month. And not because we don't have a ton of other demand, it's because I'm very selective about what loans we're putting out, because it's my investors' money. And this is my first fund, and we're going to make it really, really successful in the next 5 years. And we're going to do a full audit. And then I'm going to have a very strong stool to stand on as I continue to grow and raise additional funds in other projects in the future.
I love it. Holy cow. Loren, my goodness, I have about 1,000 other questions that I'd love to ask you, but I'll definitely be conscious of your time, because I know we're coming up just under an hour. But first off, thank you. My goodness, this is amazing. I really do. I'd love to have you come back another time, because there's so many other different topics we could dive into
anytime.
But if anybody wants to reach out to you, either just for like knowledge or content, pick your brain, or even just to borrow from you, what's the best way to find you?
Two ways. So I'm fairly active on Instagram. So it's invest with Loren, Loren. Or you can go to our website. It's reihighyield.com. And you'll see all of our investor products there. And then you can basically book a call with our team and we'll talk to you, especially if you're interested in investing in the fund.
I
If
love
you're
it.
interested in borrowing, reach out to me on Instagram. And our website is reidoubleclose.com currently for that.
Perfect. Okay. And we'll definitely put all your contact info and everything down in the show notes. So if anybody wants to get a hold of Loren, you can find his info there as well. But again, Loren, thank you so much for coming. I appreciate your time and the wisdom and knowledge you've been able to impart with us. And until next time.
Yeah, thanks for having me.